Even in the fall of 2008, consumer spending online at Amazon, eBay, Google, all these places, even Yahoo, which was based on display spending, was flat or up. It was not down. It was not down maybe anything more than 10 or 20% for a period of a few months. If you're an internet entrepreneur, buy sunglasses. The future is motherfucking bright, guys. Get out there and kill it. Yes, that is worth clapping about. However, unfortunate news for you as a corollary to that statement, you're all motherfucking stupid, you can't build products for shit, you don't know your customers, and you're gonna fail. Sorry. Most of you will fail. Take a look to the left, take a look to the right. You better hope those motherfuckers fail, because if they're not failing, it's you. 1 out of 3 odds would be great, actually. So, the world is better, but it's still not likely that you're going to be successful. However, these two things, building products cheaper, faster, better, most importantly, getting customers easier and more measurable. Why is this interesting? Well, if we can actually figure out those things in short periods of time on small amounts of capital, and we can learn from the data from our customers, particularly consumer and small business focused services, the feedback loop is very tight. We can make decisions in close to real time, and we don't have to spend large amounts of money building stupid fucking products. We can actually target the customers that have the problems better and faster than ever before. If we're wrong, we can learn from that, and we can hopefully get to a situation where we can get numbers of those customers paying for the product quickly. I.e., we can build products in months, not years, maybe even in weeks sometime, and for many of those platforms, we can actually get people to pay us right away. So when we think about like the platform kind of approach, most people still think about platforms as features, but what I encourage you to think about is platforms as opportunities for acquiring users and monetizing users. And again, we have 5 or 6 new platforms that are hundreds of millions of users or better. Of those 3 things, what do you think is most important? Anyone? Users, right. What's next most important? Money, right. Features, helpful, interesting, but not the most important thing when you're running a business. Users and monetization, very important. Solve a problem, you can have shitty features, and as long as you solve a problem for people materially better than the competition, if you're on platforms you can get those users and monetize them, you will be successful. There are many platforms to acquire users these days. In search, both on a paid and organic basis, Google is killing it. There are other search platforms, but largely if you speak English or a non-Asiatic language, that's your platform. In social, it's Facebook and Twitter, now even also Zynga and LinkedIn. On mobile, it's Apple right now, Android maybe in the future, although I'm still extremely bullish on Apple in particular. I think people are under-prioritizing the iPad. Let me say that again. Startups, entrepreneurs, investors are under-prioritizing the iPad. Extremely monetizable device. Challenging sometimes to get distribution. You may have to pay to get promotion into like the top apps before you get organic adoption, but extremely good platform for monetization. There will probably be 40 to 50 million of those devices active in the North American continent over the next 12 months, likely double that or triple that in the next 2 to 3 years. Media, I think YouTube is also an under-prioritized platform, not if you're doing entertainment or music or video, but for everything. YouTube is an important advertising and distribution platform to 300 million users or better. It surfaces well on organic search on Google. And just released is you can actually pay for promoted videos. Extremely important. Check out annotations on YouTube and find out what they're about. Lastly, inbox, messaging communications. Email is not dead. Still plenty of opportunities in email. I particularly think Gmail is an interesting opportunity depending on how much Google promotes third-party opportunities there. Other platforms also large. So, if you're thinking about building a business for the web, I would encourage you to keep it simple. In many cases, you are rebuilding Web 1.0 just with social products, with better distribution and with better monetization. There are some interesting new things that are happening. In particular, payments and monetization have gotten a lot better in many developing economies as much as in the US and North America and Europe. E-commerce, you may have heard of this thing called sort of group buying. I believe that's starting to get some attention somewhere. I would still encourage you to think about social distribution as importantly as search distribution, but search is not dead either. So largely speaking, solve a problem, sell something, use these basic plumbing and tools that are available now through much of this infrastructure for dealing with payment, monetization, distribution, search, whatever, and then make some money. Okay, so the incubator thing that's happening. Again, not just a trend, not just a fad. This is actually because experiments cost less, you can do more of them. The fail rate's still high, but you can be efficient about use of capital. In particular, experiments costing $0 to $100,000, maybe your fail rate's 60 to 80%, but you're still going to get some success out of that. So instead of doing Series A investments that typically would have cost you $1 to $3 million, you can now do 20, 30, 40, maybe even 100 experiments. Maybe 10 to 20 of those are interesting, and then focus on your Series A investment opportunities based on those winners. So incremental investment based upon success, but start with a large sample size and expect failure. What's also interesting with those many small experiments is common platforms or customers. So I can go attack a platform, I can go attack a customer segment with multiple experiments. Right now, I think parent, family, and education is a very interesting customer segment. I want to do about 10, maybe 20 investments this year focusing on that particular category. I think that YouTube and iPad are an interesting segment. I want to go do 10, 20 investments on those. Again, most of those will fail, but a few will succeed. Once I figure out what's succeeding, you can take some of those ideas and reapply them to other solutions. Physical proximity matters. When you have small teams working together, they can see and communicate with each other on what's going on. You don't always need that, but it helps. Particularly if you have team sizes of maybe 2 or 3 people, you can get 10 or 20 teams in one particular location, and they can compete and they can learn from each other. What's interesting is when you have 3 to 5 amazing outperformers, they start challenging each other, right? So if you think that you have an 80% fail rate, you might choose an initial set of company sizes around 25. 5 of those 25 are outperformers. They challenge each other, and then they also provide examples for the rest to get pulled up. So you might get the B students, the next 5 to 10, that wouldn't normally have been successful, seeing the successful behavior models of the winners, and they adopt and copy some of those behaviors, and maybe a few of them are also more successful. So compressing and facilitating people working on similar customer segments, similar platforms, within physical proximity, and seeing them be successful breeds more success. So much of what we're doing is not necessarily teaching people. I think I'm smart, but I don't think I've solved everything. Oftentimes, they're teaching us. You're facilitating learning in a peer-based environment on quick, iterative processes, and feed the winners. Iteration and metrics are important to understand what's successful. Incremental investment, higher risk, but high reward. As an example, we ran a Facebook fund about 2 years ago, summer 2009. It had previously been a different type of program. We moved it into an incubator model, followed a lot of the things that were successful about Techstars and YC, but focused specifically on platform solutions around Facebook. Of those 22 startups we funded, initially with a small amount, about $35,000 each, 8 of them got to $500,000, 1 of them got to outside success, 3 to 5 of them are still functional and actually performing pretty well. So relatively low success rate, but also relatively low capital spend. And so this is the model that's now emerging for venture capital that I don't think is just, trendy. It's not a fad. It's that the cost structure for product development, the cost structure for customer acquisition has come down. The response time for the market is faster, right? We've learned that by having people attack similar platforms in physical proximity is important, so we've ratcheted up the team size. Y Combinator is now doing 43 companies per session twice a year. They're not physically located in the same facility, but he's decided to ratchet up that team size. Techstars is doing 10 people in physical locations in multiple cities. So if you look at the structure of this, we're now filling in the bottom, right? The larger venture capitalists are deciding to bet on winners. They want to see traction first, so they're not going to do as much risky things at the bottom. And also other people are filling in those layers and now doing a lot of the other riskier experiments. It's not clear who gets the best returns, but the functional roles of each are starting to be filled in by different focused experienced investors. At the earliest stages, we're focused on product. At the next stages, we're focused on market. At the last stages, we're focused on scalability, operations, maybe even trying to figure out some financial leverage as well. So venture capital is still going to be relevant, particularly for capital-intensive industries or for capital-intensive stages of internet businesses. They're not capital-intensive largely at the beginning when you're figuring out product. They may be capital-intensive as you start to figure out market and do more massive customer acquisition. One thing that is also happening that's different, because we're more capital efficient, generally founders are not giving up quite as much equity anymore. What does this mean? It means they're largely going to be willing to sell for less because they own more of the company. Now, not all of you are going to be economically focused. There's other reasons to do startups. But largely, a lot of VCs are starting to deal with this thing they call the $50 million problem, which is for many entrepreneurs who own 10, 20, even 40, 50% of their company, who get an offer of $50 million for exit, are extremely motivated to take that offer. There are not a lot of reasons to turn down $20 million in post-tax money. That does change your life. Now, for those who are very ambitious or have other reasons, you might continue going after that. But what is largely happening in the VC world as a result of that is later stage VCs are buying out founder liquidity in large Series A and certainly Series B deals. So when they're doing the $5 to $10 million, sort of investment, they might be taking $1 million off the table. If they're doing $20 to $30 million investments, they're probably taking 3 to 5 off the table. It's not happening in all situations, but in order to align incentives of entrepreneurs with the incentives of large VCs, some money being taken off the table when there's some amount of traction is necessary in order for them to go beyond the $50 to $100 million target. What does this mean for entrepreneurs and small seed investors? Well, it means those $25 to $50 million targets might be good enough for you and might be good enough for your investor. There's a much larger range of options to consider now because cost of capital